Hi, and a very warm welcome to the second video in the session Introduction to Accounting. In this session, we will talk about some of the key terms that we need to understand even before we try to apply the knowledge of accounting that we will gain over a period of time in recording the transactions of a business entity. So, the first and foremost thing that we need to understand is what is an asset. Asset is a resource controlled by an entity as a result of past events from which future economic benefits are expected to flow to the entity. Assets represent valuable or economic resources owned or controlled by an individual or an organization. So we can say that anything which has got some economic value or which is of some value, which is owned and controlled, or we can say the resource may not be owned by the business, but it is under direct control of the business entity. For example, if we have taken something on rent, so the person who owns the asset is different, but the person or the entity who is using the resource or who is controlling the resource is different. So either ways, if anything is in the control of a business entity with an objective of gaining economic benefits is termed as an asset. For example, a car owned by a business, a factory, a building, or machinery, or computers, or laptops, whatever is owned or controlled by the business in order to conduct its business on day-to-day basis is termed as an asset. Assets have some characteristics, which are the assets have economic value that can be expressed in terms of money, or it can be expressed in monetary terms. The assets are owned and controlled or controlled by the business entity. It is result from the past transactions or events, means the assets are purchased. So the purchasing or the very activity of owning a asset has already been done in past, and the assets are expected to provide future economic benefits. Means the asset what we are purchasing today, for example, we are purchasing a shop today so that we can start our business from that very shop in future. So assets are expected to provide future economic benefits. Last but not the least, the asset can either be a tangible asset or it can be an intangible asset. So what is tangible and what is intangible is something we are going to discuss in the next slide. Depending on three categories, depending on three criterias, that is convertibility, physical existence, and usage, assets can be classified into 6 different categories. So first we will talk about what are convertible assets. When the assets are classified on the basis of convertibility, they are divided into two categories. That is current assets and fixed assets. When we say current assets, then what we mean is current assets are the assets that can be easily converted into cash or cash equivalents, typically within a period of 1 year. Current assets are also termed as liquid assets. And some of the examples of current assets are cash, cash equivalents. And when we say cash equivalents, it can either be a check, or it can be a bank draft, or it can be a promissory note, so on and so forth. So when we say cash equivalent means something which is almost equal to cash, but it is not real cash. Then short-term deposits. When the business has some extra cash available with them, they can invest or save it with the bank for a shorter period of time, which is normally less than a year. Accounts receivable. Accounts receivable refers to all those accounts, personal accounts primarily, which represents any amount that business will receive in future. Inventory, when we say inventory, inventory refers to the stock, and the stock can be of finished products which are ready for sale. The inventory can include work in progress. That means uh, those items which are still in the process of manufacturing. The manufacturing or the process of creating that product has not been completed, or even the raw material. By raw material, what we mean is those items which are required to produce the finished products. Then next is marketable securities. By marketable securities, what we mean is it can be share of a company, it can be a debenture of a company, or it can be government securities, or it can be bonds. So these are some of the documents which can easily be uh, sold or bought in the market. Then we have got office supplies. Office supplies means those items which are required in office on day-to-day basis. For example, uh, registers, pen, pencil, stapler pins, sellotape, so on and so forth. So all these are termed as office supplies. So these type of assets are termed as current assets or liquid assets. And these are converted into cash within a period of 1 year. Next is fixed assets. Fixed assets are also termed as non-current assets. These are the assets that cannot easily or readily converted into cash or cash equivalents. Non-current assets are also termed as fixed assets, long-term assets, or hard assets. And some of the examples of fixed assets are land, building, machinery, equipments, patents, trademarks, etc. Why these are called fixed assets? Because of two reasons. Number one, these assets are used in business for a longer period. That means a period which is normally of more than 1 year. That is first thing. The second thing is these assets cannot be easily converted into cash or cash equivalents. Means these cannot be easily sold out. For example, if you have a piece of land and you want to go and sell it out, then it will take a considerable amount of time before you can actually sell out that piece of land. So the primary two features of fixed assets are: number one, it is used for more than 1 year period. Second, these assets cannot be easily converted to cash. Then, on the basis of physical existence, the assets are classified into two categories, that is, tangible assets and non tangible assets. Tangible assets are those assets which has got a physical existence. Means these are those assets which has got a physical existence. We can touch these assets, we can feel these assets, and we can see these assets. And some of the examples are like land, building, machinery, cash, office supplies, inventory, marketable security, etc. So any asset that has a physical existence, which can be touched, which can be felt, or which can be seen, is termed as tangible asset. When we say non-tangible assets, these are those assets which don't have a physical existence. One can neither touch them, nor feel them, nor see them. And some of the examples of non-tangible assets are goodwill, which you can say is the reputation of the company or the business entity, or even you can say the respect that it commands in the market. Patents, these are the rights that a particular business has because of some uh, research and development, the designs what they have created. Brand name, copyrights. Copyrights are again the legal rights which are provided to a particular business entity for using something which is not available for general public to use. And this is primarily used in case of uh, work related to art, like copyrights for a movie, copyrights for a music, so on and so forth. Then trademarks. Trademarks are nothing but the logos or the colors or a particular symbol or a tagline. Then trade secrets. Every business entity has something unique. How they are doing their business, what are their pricing policies or strategies, or what market they are targeting. All these are termed as trade secrets. Licenses and permits to carry out a particular type of business or to do a particular type of an activity. Then intellectual property. If the business has developed something at its own, so these uh, uh, the rights to use them, or that particular thing which has been developed by the business entity. It can be as simple as uh, a program or a software. So these things are termed as intellectual property. So we cannot touch any of these. Any of these things don't have a physical existence. We cannot feel them. We cannot see them, but they add value, or they make the business uh, enable to earn revenue or earn profit. They add to the capacity of the business to earn revenue. So that's why these are also considered as assets. When we say operating assets are uh, those assets which are required to perform the day-to-day operations of the business, or the assets which are essential to carry out the day-to-day activities of the business. In other words, operating assets are used to generate revenue for a company or a entity, its core business activities. Without these operating assets, the entity cannot continue its day-to-day activities. For example, cash, accounts receivable, inventory, building, machinery, equipments, patents, copyrights. So, if you are running a business, And if you are in a business where you are manufacturing something, so you cannot take away the machinery even for a single day, or you cannot take away the building which in which you are making the material. So these are the things which are required on a day-to-day basis or on a daily basis. So such assets are termed as operating assets. Then we have got something called as non-operating assets. So non-operating assets are those which are something of economic value or are valuable, which are adding to the earning capacity of the business, but they are not required on a day-to-day basis. Even if these assets are pulled out of the business uh, uh, for a considerable time period, then also the business can function as usual or normally. For example, short-term investments. So whether you have cash at bank or not, that is not going to impact your day-to-day functioning. If the business has a vacant piece of land where there is no building, no factory, nothing, then also it is not going to impact the functionality of the business. So the this is the classification of assets. Now we will talk about what is a liability. So a liability is a present obligation of an entity arising from past events, the settlement of which is expected to result in outflow of resources, embodying economic benefits. Simply put, liabilities represents what a business owes to other. Let me explain this with an example. So today, the business entity needs to pay 10,000 rupees to Mr. X. And why the business needs to pay rupees 10,000 to Mr. X? Because the business has purchased goods from Mr. X worth rupees 10,000. So this amount of 10,000 that needs to be paid to Mr. X is present obligation or present liability of the business entity. And this liability or obligation is arising from the past event. What was the past event? Purchasing of goods. Now, when we are trying to settle this liability, when we want to close this liability, what will happen? Outflow of resources will happen and it will have economic benefits. So what we are going to do, we will have to pay to Mr. X in cash or by check or by a bank draft. So in any of the cases, there will be a outflow of resources, that is cash, either cash from the hard cash or cash from the bank. So we can simply say that liabilities represents what a business owes to other. That means the amount what the business needs to pay to others. This is termed as liability. Some of the key characteristics or features of liability are obligation to transfer economic resources. That means it is our commitment of the business that they will transfer some economic resources. As we have discussed in the previous in our example, that we need to pay rupees 10,000 to Mr. X. So this is cash is a economic resource and this is our obligation to pay. Then arise from past transaction or event, that is something we have already discussed. then settle through payment of cash, transfer of assets, or rendering services. Now, let's understand this a bit. Once we have assumed a liability or the business has an obligation to pay, they can settle the liability either paying it in cash or say for example to Mr. X, we can say that, okay, we don't have money. What we can do is we can give you goods in return worth rupees 10,000, or we can give you some machinery worth rupees 10,000. So here we are settling the liability by transferring the assets or by rendering services. We can say that, okay, we don't have money, we don't have any asset that we can transfer, but what we can do is we can sell your products, or we can let you use our shop to do some brand promotion or to do some kind of branding in our shop free of cost. So here we are not giving them cash, we are not giving them asset, but we are rendering some services. So these are the different ways how liabilities can be settled down. Next is can be in written in legal agreement or expected because of past action. So at times the event has not occurred, but we have assumed in a agreement which is legally enforceable. Suppose today the business issues a purchase order or gives in writing to Mr. X that we will pay you rupees 10,000 after 1 month. So here it is a legal agreement rather than purchasing the goods. So these are the primarily two ways basis which a liability can arise. Then liabilities always result in outflow of economic benefits. So these are some of the key characteristics of liability. One more thing, the liability can be current or short term. That means a liability that needs to be paid within a time frame of 1 year. That is known as current liability or short-term liability. Or it can be a non-current liability or a long-term liability. If any liability needs to be paid after 1 year, then it is termed as non-current liability or long-term liability. When we talk about types of liability, the first one is current liability. As we discussed just now, current liabilities are those liabilities or obligations which are due for payment within 1 month. And it includes accounts payable, short-term loans, current portions of long-term debt, accrued expenses. So I will touch base on couple of things, but we will discuss these terms in detail in following sessions. So accrued expenses are those expenses which has already been incurred but still has not been paid. For example, the payment of your postpaid mobile. So when we say postpaid connection, that means what? First we will use and later on we will pay. Similarly, we have availed some services like electricity bill. So first we use the electricity, then at the end of the month, we receive the bill and we pay it in the following month. So here accrued expenses means the benefit has already been received and now we need to pay. And then unearned revenue. Unearned revenue means some payment for something that we have received in advance and still we need to uh, uh, provide the goods or render the services for the amount that we have already received. For example, you have made an advance payment to someone. Uh, like when you are ordering books, at times the bookkeeper says that, okay, this book is very rare. So you first give them money and later on you receive the book. Or at times we pay the tuition fee in advance. So first we pay the fee and later on we take the classes. So for the shopkeeper or for the tutor, the amount what they have received in advance, even before delivering the books or even before imparting the classes, can be termed as unearned revenue. And suppose tomorrow, if you don't take the book, the shopkeeper will, or if the shopkeeper fails to provide you with the book, he will have to refund that money. So that means it's a liability for him. This requires settlement within the normal operating cycle or within a time frame of 12 months. The next type of liability is non-current liabilities, obligations which are due after 1 year. Non-current liabilities include long-term loans, bonds payable, lease obligations, pension liabilities, and deferred tax liabilities. These liabilities extend beyond a single operating cycle, that means more than 1 year. The last is contingent liability, potential obligations which are dependent on uncertain future events. So this is something good to know for you. Right now, we will not go into too much depth in regard to contingent liability. Just understand this fact that today this liability is not a real liability. The business is not under any kind of obligation to pay money against these liabilities. But some event which is going to happen in future will decide whether the business will actually require to pay this amount or not. For example, there is a case pending at the court of law. And if the court decides that the business needs to pay a certain amount, then only it will become a liability. If the court decides that no, the business entity is not at fault and the business don't need to pay anything against the claim, then there is no liability for the business. Next, we will talk about what is capital. Capital is nothing but it represents the owner's financial interest in the business. It is actually the amount invested by the owner or owners to start and grow the business, creating the foundation of operations and expenses. Simply putting it, it is like the amount invested by the owner in the business is termed as capital. Then the next thing that we are going to discuss is what are expenses. So expenses are the costs a business has to pay in order to run its daily operations and earn income. Expenses are the money spent to keep the business going, like paying the rent, buying material, paying salaries, paying electricity bills, so on and so forth. They are like the outgoings of a business. Whenever you are running a business, in order to keep the business going on or in order to keep the business running, you will have to incur some expenses. For example, you have taken a shop on rent, you will have to pay the rent of that shop. You will have to spend some money in buying the goods that you will be selling out from your shop. You will have some people working for you. You will have to pay salaries to them. In your shop, you will be using some electrical appliances like electricity bulb, tube lights, fan, cooler, AC, whatever. For that, you will have to pay the electricity bill, so on and so forth. So this is like outgoings of the business. How expenses impact the business? It results in reduction in assets or increase in liability. And any expense incurred by the business, it reduces the profit of the business. We can say expenses represents the cost of doing business, the economic cost of generating revenue during an accounting period. They reflect the consumption or utilization of assets or services in the process of operating a business. Unlike assets, which represent future economic benefits, expenses represent benefits that have already been consumed. Expenses are recorded on the income statement and directly reduce net income and retained earning. So how we are recording the transactions and how they are impacting, this is something we will discuss in the subsequent sessions. For now, just understand that any amount that the business is spending to carry on the business is termed as expense. That is number one. Number two, it results either in decrease of assets or increase in liability. Third, it reduces the profit of business. Fourth, and very important, the amount that the business needs to pay against expenses is paid for the benefits which the business has already received or already used or has already consumed. Moving on, we will discuss about incomes. And in nutshell, we can say incomes are just opposite of expenses. So income is the money a business earns from its activities, like selling goods, providing services, or through other sources. Income is money coming into the business. It shows how much the business has earned during a certain period. What is the impact of income? The income increases the assets and or it will result in reduction in liabilities. The more the income is, the more is the profit for the business. Income represents the financial benefit a business earns during an accounting period. It reflects the inflow of assets or reduction in liabilities resulting from the delivery of goods, provisions, or services, or other business activities aimed at generating revenue. So that's what the income is. Unlike expenses, which represents cost already incurred, income represent economic benefits that increase the owner's equity. Means the share of owner's equity means the interest of owner in the business. Means whatever amount the businessman has invested in the business, that will keep on increasing as a result of income. Income is recorded on the income statement and directly increases net income and retained earnings. So retained earnings basically means, say for example, in a particular year, if a business has earned rupees 100, so the owner is not taking that entire uh, amount, that is rupees 100. Instead of that, what the businessman has done is he has taken only rupees 60 and he has left 40 rupees in the business. So that the amount which is that part of earning which has not been given to the owner is known as retained earning. So that's pretty much about incomes. Now we will talk about drawings. What are drawings? So drawing represents withdrawal of cash or other assets by the owners of a business for their personal use. The withdrawals reduce the owner's equity in the business and represents a distribution of profits rather than an expense. So at times what happens is business owner or the businessman may need some amount for their personal use, and depending on the situation they may take out some amount from the business for their personal use. So this withdrawal of amount from business for their personal use is termed as drawings, and it is not necessary that every time it has to be in form of cash. At times the owner may take material also, or they may use even the assets of the business for their personal use. So all these will be considered and treated as drawings. Now we will talk about types of accounts. So when we talk about types of accounts, in accounting system, traditionally, the accounts were classified into three main categories. That is real accounts, which relates to assets representing what business owns. The second category was of personal accounts, which track relationship with individual company or companies or other entities. And finally, nominal accounts, which records expenses or losses or incomes and gains. And the nominal accounts are closed at the end of each accounting period. Then we have the modern classification of accounts. And in the modern accounting system, accounts are typically classified according to the accounting equation components. And the accounts are classified into five categories, that are asset accounts, liability accounts, equity accounts, revenue accounts, and expenses accounts. This organization facilitates financial statement preparation and analysis. We will look in detail the classification of accounts. When we say classification of accounts on the basis of classical approach, first the accounts are broadly classified into two categories, that is personal accounts and non-personal accounts. Personal accounts are further subdivided into three categories. That is natural personal account. So these are those accounts which are related to natural person. That means a person who has got a physical existence. Like account for Ram, account for Sham, account for John, account for David, account for Rahim, so on and so forth. The second category under personal accounts is artificial personal accounts. So artificial personal accounts basically represents those accounts which are tracking the transactions for artificial person or person created by law. These accounts can be related to a business institution. This can be representing any institution, a company, or maybe a cooperative society, so on and so forth. So, for example, uh, account for ICICI Bank, account for ABC and Company, account for Agra University, or account for Apple, so on and so forth. Then the third category is representative personal account. The representative personal accounts are those accounts which are actually for a person, but it is these are those accounts which are representing a person, like in the uh, sole proprietary kind of a business setup or a partnership kind of a business setup. We don't create a account for the owner by his name. Instead of that, we create a capital account to track the transactions related to the amount invested by the owner in the business. Similarly, for any amount that is withdrawn by the owner from the business, we don't create an account in his name or her name. Rather than what we do, we create an account named as drawings account. So the capital account, the drawings account, these are the accounts which is representing the owner. That's why these are termed as representative personal account. In addition to this, if we have any account related to a expense which is payable in future, for example, salaries payable account, wages payable account, electricity expenses payable account, all this will also fall under the category of representative personal account, because these are those accounts which represents the amount which is payable to a particular institution or an individual at a later date. When we come to the second category of accounts, that is non-personal accounts, the non-personal accounts are further classified into two categories, that is real accounts and nominal accounts. Real accounts are further classified as tangible real accounts, which uh, are prepared to track the tangible assets, and non-tangible real accounts are those accounts which are prepared to track the non-tangible assets, or we can say the real accounts are basically prepared to track the various types of assets. Then we have got nominal accounts, and nominal accounts are further classified into two categories, that is income accounts and expenses accounts. Income accounts are prepared to track all the incomes or gains that business is earning, or to track all the expenses or losses that business is incurring or the business has suffered. One very important thing that you should uh, keep in mind is the nominal accounts are closed at the end of every accounting period, and their balances are not carried forward to next accounting period, whereas the personal accounts and real accounts are not closed at the end of accounting period, and if they have any balance, that is carried forward to next accounting period. Let's discuss more on the types of accounts. When we talk about real accounts, as we said, these real accounts represent assets and liabilities of business. They show the financial position at a specific point in time, and their balances are carried forward to next accounting period. This can be tangible like land, building, equipment, etc. Intangible, patents, copyrights, goodwill, etc. When we talk about rule, the golden rule of accounting that is applicable for real accounts is debit what comes in and credit what goes out. Then we talk about personal accounts. Personal accounts, as we discussed, represent transactions with individuals, companies, or other entities. They track amounts owned to or by the business. It can either be a natural person or a artificial person. The rules which is applicable for personal accounts is debit the receiver, credit the giver. Finally, we have nominal accounts. Nominal accounts represent income, expenses, gains, and losses. They are temporary accounts and are closed at the end of each accounting period. Examples are for income, we have got sales account, commission, interest, and so on and so forth. And for expenses, we have like rent, salaries, utilities, etc. The rule applicable for nominal accounts is debit all expenses and losses and credit all incomes and gains. Now we will look at the classification of accounts as per the modern approach. And in modern approach, the accounts are classified into 5 categories, that is assets, liabilities, equity. Again, equity represents the amount invested by the owner of the business, or you can say equity account or capital account. Then we have account for incomes, and then we have accounts for expenses. And when we talk about the rules of debit and credit, the asset accounts are debited when there is increase and credited when there is a decrease. In case of liability, if there is a decrease in liability, it is debited. When it is there is an increase in liability, the liability account is credited. Equity account or capital account is treated exactly the same how the liability accounts are treated. Whenever there is a inflow of capital, it is credited, and whenever the owner withdraws capital, it is debited. For revenue accounts, whenever there is a decrease in revenue, it is a revenue or income. Whenever there is a decrease, we debit it, and whenever there is an increase in revenue or income, we credit it. And then we have got expenses account. If there is an increase in expense, the account is debited. When there is a decrease in expense, the account is credited. And finally, we have got drawings account, and drawings account is uh, treated exactly the same how the expense accounts are treated. So if there is any increase in drawings, it is debited, and if there is a decrease in drawings, it is credited. In double entry bookkeeping system, it is required that for every financial transaction, at least 2 accounts must be affected. And when those 2 accounts are affected, the uh, total of debit side and credit side should always be equal. This ensures that the accounting equation remains balanced. The terms debit and credit simply refers to the left side and right side of ledger account respectively. So here we have come across a term called accounting equation, and this is what we are going to discuss in our next session, that what accounting equation is, how it is prepared, and what is a ledger account, how it is prepared, how it looks like is something that we will discuss in subsequent sessions. The effect of debits and credits depend on the type of account. For assets and expenses, debits increase the account balance, while for liabilities, equity or capital and revenue. Credits increase the account balance. Understanding these rules is fundamental to proper accounting practice. So, if you really want to master the art of accounting, you must know the three golden rules of accounting. You must know when to debit a account and when to credit a account. With this, we come to an end of this session. See you soon in the next session. Thank you.